The following podcast was recorded on Wednesday, August 21st, 2024, featuring Jim Bianco of Bianco Research. To hear the podcast in real time, you can sign up for a free trial at biancoresearch.com or arborresearch.com, or by emailing Gus Handler directly at gus.handler@arborresearch.com. You can also call Arbor Research and Trading at 1-800-606-1872. Thanks for your time and enjoy the podcast. Welcome everyone to Talking Data. I'm your host, Kristen Radosh with Arbor Research and Trading, joined today by our commentator, Jim Bianco of Bianco Research. Welcome, Jim.
Thanks for having me.
Today, Jim discusses why retail sales and consumption is staying strong. Jim, you've argued in the past that financial crises and recessions change the economy, and we had both in 2020. To start us off today, what's going on with consumption and retail sales?
Yeah, so the short answer is that they're doing very well. So if we go to the first chart, motivation for this was a tweet put out by Bill Gross the day before we're recording on August 20th. Hard to measure, but I suspect that the upper middle class and wealthy are finding millennials and younger generations are funding millennial and younger generation spending by transferring cash assets and paying bills, and in the process, pumping up retail sales in the economy. In essence, they are liquidating balance sheets to pay for spending. This is likely to continue as long as stocks and housing prices stay elevated. So what he's arguing is a version of the wealth effect, right? So people are making a lot of money in the stock market, their house prices going up, and they're using that money to support their children, the millennials, and that all makes sense. But it's also a variation of a theme that we've also seen over the last couple of years, that there was another wealth effect going on. I know it's not technically a wealth effect, but it effectively acts like one, and that was the government mailing everybody stimulus checks, and economists were trying to measure what they called excess savings. You got all this money in the bank account. Have you spent it all yet? And so that is another thing they were doing. Now, what they were implying with this was that behavior changed. I'm sorry, what they're implying with this is behavior didn't change, and that we just had found money, and we were starting to see people start to spend that found money. And to that end, let's go to the next chart, and let's talk about how they were spending that money. So the top panel shows you retail sales in blue. This is the monthly change in retail sales. And the orange line is what Wall Street estimated for each month. And the bottom panel is just the difference between the orange line and the blue line in the top. A green bar means the numbers beat estimates, and a red bar means they came in below estimates. In the last 31 months, which goes all the way back to January of 2022, there's only been seven misses, where the retail sales came in below estimate. There's been 20 beats, and there's been 4 that have been right on the number. So you can see that the numbers have been very, very strong on retail sales. So if we jump to the next chart, consumption. Now, countries measure consumption a little bit differently, but we actually have a measure in the GDP called consumption. And you can see that is the black line is the United States. This is the 2024 estimate for what consumption will be as a survey of 70 economists by Bloomberg. Bloomberg has like an open survey of 70 odd Wall Street and buy-side economists. And whenever they change their forecast, they just update their Bloomberg terminal, and that's what it shows. So the black line is the US. The consumption numbers, this is, consumers, buying stuff and goods and services, is way ahead of the Eurozone, Germany, Japan, and the UK. So what we're seeing is the US is standing alone in consumption. And if we go to the final chart of this section, this is GDP. So all that retail sales, all of that consumption is leading to very strong estimates. Same chart idea, 2024 estimate of GDP, 70 economists, just continuing to update. Black line is the US. The estimate for our growth, our GDP, is 2.4%. And you can see all the other countries are down under 1%. So we are standing alone in terms of the strength of the US economy, what is expected this year versus everybody else. What is driving this is consumption And that's showing up in the retail sales numbers, always are beating, 20 of the last 31 months, and only 7 of the last 31 months has it come in below estimate.
Jim, why is this happening?
So let me go back to the gross tweet again. And remember, he said that it's the boomer generation is making money off of their house price and their stock prices, and they're transferring these assets and cash to paying the bills of their children. And I have no doubt that that's indeed the case. And as I mentioned earlier, the idea that you also had excess savings because of all the pandemic stimulus checks were mailed. The assumption in all of this is that nothing has changed, but we just found some money and we're spending this extra money. And as long as the stock market stays up, as long as we have excess savings, the savings will continue, the strong retail sales and consumption will continue. But when we run out of that money, it will be the end of it. I don't disagree with that, but I think that there's something more going on. So if we turn to the savings rate chart, this is a chart of the personal savings rate. Now, the personal savings rate is personal income, which is effectively your wages that you make from your job plus transfer payments, government transfer payments. So if you get Medicare or Social Security, or you get welfare or something like that. So that's for the whole country. Personal income, less disposable, less spending. What's left over is the savings rate. Now I put 3 annotations on this chart. The green line from 1991 to 2007, the blue line 2010 to 2020, and the red line 2022 forward. What am I showing here? In 1991-92, the savings rate was around 10%. By 2007-8, it had fallen to under 2%. Or if you want to think about it this way, in 1991, we were spending, as a nation, we were spending 90% of our paycheck, saving 10% of it. By 2007, we were spending 98% of our paycheck, and we were saving only 2% of it. What changed? What's not in the savings calculation is asset prices. So if you have a stock portfolio, you have a home, and your home estimate is going up, or your brokerage statement keeps swelling, you might think, well, there's my savings. There's how I'm going to retire. That's my rainy day fund. I could spend more of my paycheck because my brokerage statement keeps going up. My house price keeps going up. And so that's why the savings rate kept falling and falling until 2007. Then we had the financial crisis that blew up that whole idea. And coming out of the financial crisis, 2010 to 2020, is the savings rate in the post-financial crisis. It then didn't average under 2%, it averaged 6%. We learned from the financial crisis. We had a crisis, we changed behavior. We learned from that change of behavior, we got to save. We got to have a rainy day fund. We have to have a just in case fund. And we did that. And for the many years after the financial crisis, economists complained people aren't spending enough money to get the economy going. Well, it's because they were saving it. Then we got to 2020. And initially, when the shutdowns came, I'm sure a lot of people that saved and exercised discipline said, boy, I'm glad I did that. Now I've got some money because things are getting ugly. But then and this is my interpretation, then they felt kind of foolish because their neighbor who didn't have any discipline and spent all their money got stimmy checks mailed to them. And to make it worse, if you were one of those that was disciplined and saved, you didn't qualify for a stimmy check. So coming out of and by the way, how big were the stimmy checks? Look at those 2 spikes on the chart. April 2020 at 32% and March 21 at 26%. That this first stimmy check was equal to 1/3 of all the income, 4 months of salary on the average person in the United States. And the second one is equal to 1/4 of all income. That between April 2020 and March of 21, we effectively sent everybody the equivalent of about 6 months of salary in terms of stimmy checks. So we changed behavior. Why did I save? Why did I be austere? Now I'm going to spend. We're going to go to Italy. We're going to buy the things that we want. So if you look at the red part of the chart, the savings rate is averaged 3.9%, or 1/3 lower than it did during the post-financial crisis period. In other words, what I'm trying to say is we want to think that behavior hasn't changed. There's this found money because the stock market's going up or excess savings is causing all of the retail spending. I think that's there, but I think it's incomplete. We have a different attitude. My different attitude is I'm just going to spend and I'm going to continue to spend. Well, what about saving for retirement? What about if there's another downturn? I've joked about this before. I'll walk to the mailbox. I expect that savings I never saved, I expect the government to mail it to me because they did in 2020. And so therefore, people are spending more. So we've got a much bigger spending. So if we jump to the next chart, that shows it. So this is personal consumption as a percent of GDP. How much of GDP is made by us consuming as an individual? Now, the rest of GDP is made up by government, it's made up by investment, it's made up by trade, but the vast majority of it is individual spending money. The blue line shows you that the average amount of consumption as a percent of GDP post-crisis was 68.6 or 67.6%. Coming out of Omicron, which is why I start these charts in 22, because Omicron had the mini shutdown in 21, and then we were completely done with it by the end of 21. We've been averaging 69.2%, almost 2 percentage points higher in consumption. Is that a big deal? Yeah, because it's pushing up GDP by about 1.5%. So you've been seeing very strong GDP because of these higher consumption levels. Go to the last chart. The last chart shows you GDP. Now, there's a couple of colors on the chart and some annotations. Let me start with the shaded area. That's 2 to 2.5%. That is what is called trend or potential growth. Economists like to say, what should the growth rate of the economy be? No one's trying to stimulate it or restrain it. What should it grow at? We don't know. It's just guesses, but the guess is 2 to 2.5%. So that's the shaded area. The brown bars on it are quarterly GDP before 22. Then we had the 2 red bars in 22, the contraction bars. I'll talk about those in a second. And then we had the 8 or so green bars after that contraction. You will notice that in the brown bars and the green bars, and then the blue one is the latest Atlanta Fed for the third quarter estimate. But the brown bars and the green bars, 10 of those 13 quarters, we grew at trend, if not more. And so the economy has been growing very well. Now, the first half of 22, we had 2 consecutive quarters of contraction. That was only the second time in American history we've had 19 or 21 of them, and 19 such contractions, consecutive GDP contractions, have always been a recession. The 2 that have not been was 1947 and 2022. Now, the reason is, what is a recession? There's the National Bureau of Economic Research's cycle dating committee. It's 8 economists that get together and they anoint something a recession. They did not anoint these back-to-back quarters of contraction a recession. But, you know, why did it go down? 25% in the stock market. The Fed was raising rates over 400 basis points for the year. Scared a lot of people. That's why I think they did. But even with those contraction, if you look at the dotted horizontal line, economy's grown at 3% since 2020. That's well above potential. That's very strong. And what is driving this is consumption. So if you look at the economy, it is being driven by retail sales and consumption. We'd like to think nobody ever changes their behavior, so there must be some found money in the form of wealth effect or transfer payments because of the stimulus checks that account for it. And again, there's probably something to that. But I also think it's about that every time we have a crisis or a recession, we had both, the economy changes. And I like to always say change is not worse. Change is not dystopian, because everybody thinks when I say the economy changes, they assume I mean worse. I don't. I mean, it's different. And coming out of COVID, we just decided, you know, maybe it's PTSD. I'm going to live my life. I'm going to enjoy myself. The Conference Board does a consumer sentiment survey. One of the questions they ask is, are you planning a foreign vacation? 18% of the country has said yes this year, that they're planning a foreign vacation. That is not only the highest it's ever been in the 40 years they've asked that question, it's far and away the highest it's ever been. So people are living their life. They're spending. Where are they getting the money? They're not saving, or they're saving less. Well, are they concerned? No, because they think that in the next downturn, that missing savings that they did, they went to Italy with the savings, that the government will mail it to them. Are they wrong for thinking that? It's exactly what the government did the last time.
Jim, how long will this last?
It'll last till we have the next recession or the next crisis or both. Now, when will that be? First of all, Rudy Dornbush, the late economist at MIT, famously said, economic expansions don't die of old age, they're murdered. So if the answer is with the wealth effect and with the excess savings, the implication there is it's going to die of old age. We're just going to run out of money one day and we're going to stop spending, and that's going to be the end of the recovery. It doesn't work that way. We will just continue to spend and we'll load up on the credit cards and we'll just continue to go and go. But there will be a murder in the economy. Now, what's a murder? It's an economic shock, usually unexpected. COVID was an economic shock. Housing prices crashing was an economic shock. The Gulf War in 1991, all of these, the Arab oil embargo in 1974, all of these things shocked the economy. And then the result was a recession. What could shock the economy now? There's lots of things. It could be high interest rates. It could be political. It could be geopolitical. It could be oil. Oil's a big murder weapon in the economy. It spikes up and chokes it off. You know, the Fed being overly tight can be one as well too, although I don't think the Fed is overly tight. But until that happens, this economy will stay strong. Then, as I like to put it in very blunt terms, then I'll be looking at my Bloomberg terminal and I'll see some red headlines come across, and I'll use some flowery technical language and go, oh shit, everything just changed when I see that headline. And that would be the economic murder that would cause a recession. Now, to be fair, sometimes you get these things that look like murders, the stock market crash of '87 or Silicon Valley Bank failing last year, that you think, man, that's it. We just murdered the economy, and it's not murdered. So it's not always so clear as to what could be a potential murder weapon. So we'll have to see. But until then, the economy will continue to go. Then what happens when we have the next downturn? Well, tell me what the response is. If the response is we mail people more money, maybe coming out of that one, then the savings rate goes to zero. Why do I save any money? Because I'm just going to spend every penny that I get enjoying myself, buying better clothes, buying a nicer car, getting more experiences, because my savings is the government sending me money. So that would be if in the next downturn they mail more money. What if they mail nobody money? And there's sorry, that was a one-off because it was a pandemic. We're not doing it again. Then coming out of that crisis or recession, people might say, okay, I got to start saving. I got to protect myself. And we see a big jump in the savings rate, and they spend much less. So what is the nature of the next recession? What is the murder weapon? What is the nature? And what is the government's response? But like I said, this cycle right now, coming out of COVID, is spending. Spend. It isn't going to stop until we have another recession. And they're not going to spend themselves out of money and then we have the recession. It will most likely be some kind of a shock to the system, a murder. The Fed starts raising rates again. Oil prices triple. Did it in 1990. Oil prices went to $145 in 2008. So that that's or double. That's possible as well. Geopolitical event, maybe political upheaval, all of the above, or something like that could cause a real shock in the economy. And then we see what the response is. Everybody's behavior changes, and then we're on to a new cycle. But this cycle, the answer is that the economy has been stronger, spending is staying strong, and the economy is staying strong. Now, the last thing I'll point out about that is, as we're recording this in late August, we're about a month away from the next FOMC meeting, and everybody expects the Fed to cut rates at that meeting. The Fed's minutes from its July 31st meeting strongly hinted that they're going to cut rates at the meeting as well too. If they cut rates and it turns out really the economy's okay and it didn't need that extra stimulus from lowering interest rates, it's just going to create inflation. If they cut rates because the economy is slowing and it helps to boost real growth, it won't create inflation. So that's why I've always been pushing back on this narrative that the Fed has to cut rates. I understand they will, but should they? I'm still not in the they should camp. I'm in the they will camp, because what I'm worried about with things like all of this spending is that it is telling us that the economy is much stronger than everybody believes, and that's been the hallmark of the last couple of years, right? We've all been looking for recessions and downturns, and things are going to roll over and things are going to get worse, and they haven't for 3 years, and we just continue to focus on saying that over and over again. But now we're going to get some real stimulus in the form of lower interest rates, and if the economy's not slowing down, all that's going to do is feed into more inflation, and that could be a big problem for financial markets as we go forward.
Jim, thank you for your thoughts today, and thank you everyone for joining us. If you have any questions on Arbor Research, Bianco Research, or Arbor Data Science, you can contact us by emailing Gus Handler at gus.handler@arborresearch.com. Thanks again and have a great day.